Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs. Hello, folks, and welcome to Advisor Upside, powered by ETF.com. I'm your host, Jeff Benjamin, Wealth Management Editor here at ETF.com. Today, we're going to be talking with Fran Kinniry, who is the head of the Investment Advisory Research Center within Vanguard's Financial Advisor Services Department. In the show notes and the Advisor Center at ETF.com, we're going to have some links to some of the research that we're going to be referencing during this conversation. But we're going to be talking about Fran's research on the markets, fixed income, where these things go, and a lot of what we see coming ahead in this kind of a unique year. Well, what's left of this year. So let's get right into it. Hey, Fran, thanks for being here.
Thanks, Jeff.
Looking forward to this conversation. We're going to be talking about some of the topics of your recent research reports that you've worked on. I want to start with concentration risk. Okay, I know we've seen a little bit of volatility recently in some of the semiconductor and artificial intelligence names, but by my count, through July 18th, the Taiwan Semiconductor is up 85% this year. NVIDIA is up 138% this year. We're talking about essentially a handful of stocks that have been responsible for the bulk of the stock market performance over the past couple of years. I think those have been referred to as a number of things, including the Mag 7. How do you convince investors to not chase that kind of performance? And this leads us into one of your reports that I referenced, or that you worked on, something about don't look for the needle in the haystack, instead buy the haystack. I think that's maybe a Vanguard mantra, but I'll let you walk us through it from there.
Yeah, thanks, Jeff. And owning the haystack is something that Vanguard is known for. Jack Bogle coined that position, and you mentioned a couple companies like NVIDIA and others, and we looked at Google search interest in the company, and even the Mag 8 or Mag 7. And what you see is exactly Mr. Bogle's theme playing out of owning the haystack, meaning that there was not great awareness of these companies. And in general, we see this through history. There's not great awareness of these companies until they actually pop in performance. And so when you look at Google search or interest in these companies, very muted interest until after you see returns of 30,000% that we're looking at with NVIDIA. And
Mm-hmm.
so the idea is you got to own these companies, and the way that you would actually own them is to own all of them through something like the total stock market portfolio. And I think that's what he was getting at. And the great news is we are seeing just the unprecedented rise of indexing as the core of most people's portfolios. So they actually do own more and more of the haystack, which is great for their outcomes.
Okay, let's talk about positioning client portfolios at this point in the market cycle, with equities at record levels, bond yields being held higher by the Fed and other economic factors. We've got that inverted yield curve. Remember, we're talking primarily to financial advisors, Fran. So what are you seeing out there that might be a kind of a wise strategy?
Yeah, very much like owning the haystack, a wise strategy is not trying to time the markets. Jeff, we're having this conversation in July of 24, but most people were calling the markets overvalued a year ago,
Mm-hmm.
2 years ago, 3 years ago. And so there's more bear market created by investors on their own by trying to time the markets. We've done so much research on tactical asset allocation funds, go anywhere funds, and even just the case for indexing in general, where you see indexing outperforming 70 to 80% of managers, both on the equity side and the fixed income side, would really give you a strong conclusion that timing the markets is a fool's game. There's no real research that shows doing that has helped. And that includes just, I know we're talking about the equity market here, and we might talk about the bond market. It also includes calling interest rates. We've done a ton of research on, trying to, time interest rates. And the case for indexing is as strong on the bond side as it is on the equity side.
I love that reference to bear markets being created by timing. That's that's excellent. All right, let's talk about the Fed. It's as you referenced this July. The There are still people thinking that there's going to be a rate cut this year. We've seen a lot of pauses. We came into the year, some people were expecting six rate cuts this year. Things happen. What's your outlook at this point for the Fed?
Yeah, I would go back to just what we talked about market timing. I mean, outlooks, forecasts, as you mentioned at the beginning of the year, most people were looking for six rate cuts. What we see is that forecasting is hard. Most have not gotten it done well. If there were really good forecasting, you would see a strong case for market timing of interest rates, and you just don't see that.
Hmm.
A better way to think about it, Jeff, is the futures market is actually, again, that changes as well as you get closer and closer to the next date of the Fed meeting. The futures market changes rapidly. And so what you're seeing now is a very strong probability that there is an increase in September. But that's not a forecast. That's just the futures market and what the futures market is expecting. Somewhere, last seen somewhere above 90%. So that would be the first rate cut that we have seen since,
Hmm.
the rise in rates. But I would say, even if you were to look at that same futures market 6 months ago or 9 months ago, the results change. And that makes sense because what drives the market is new information, and that information is changing rapidly day by day.
So you're saying kind of step back and ignore the noise, or what? I mean, it seems like a rate cut is significant considering it would go back to before COVID. Uh, is that not something financial advisors and investors should be paying attention to?
Yeah, exactly. Well, again, what is if it's already priced into the markets are forward looking. And I think that's probably maybe where most people get themselves in trouble. They believe that acting on some news um, is meaningful, that you would change your portfolio. And there's real no evidence to support that. Back to the case for what we look at tactical asset allocation funds or funds that are allowed to go anywhere, just having such a poor record. The markets are very, very forward looking. And so while it may be new news to anyone listening to this, or even news a month ago, the markets have priced this in very effectively. And so you have to be real careful when you see any kind of news come out. The professional investors jump on that information in nanoseconds. And so it gets priced into the market pretty quickly. And so a lot of people are operating on stale news.
Okay, good point. Let's talk about the cash. All right, there's by the latest calculation that I could dig up, looks like there's more than $6 trillion sitting in money markets. You're earning pretty decent yields right now because of the Fed policies that we've already talked about. I- Is that a bad thing to be sitting there in a money market or even the CD or anything else giving you yields in the 5% range?
Yeah, a couple of things I'd like to put into context. You are correct. There are $6 trillion in money markets that are sitting there. Um, But when you look at all fund allocations, so when I'm going to say all allocation, I'm going to look at equities, bonds, and money markets. That 6 trillion ends up to be around 19% of all assets invested. The median over the history is 24%. So
Okay.
while it seems like there's a lot of money on the sidelines and a lot of money in money markets, it's actually below its historical level. The second thing I would say is everyone keeps saying, will this $6 trillion be reinvested into the markets? Is the markets have had positive cash flow both on the equity side and the fixed income side year to date, 1 year, 3 year. I think a lot of people misunderstand that mutual funds and ETFs are not a closed ecosystem. And a lot of that $6 trillion that has come in the last 3 to 5 years probably left the banking system. As you
Hmm.
saw, money market, you saw there was really no penalty to sitting in cash at a bank. in zero interest rates when money markets were yielding close to zero. All of a sudden, when you have money markets yielding 5%, you see a lot of people leaving the banking sector to come into the mutual fund and ETF world for money markets. And so it's just a natural ebb and flow that we see through time of people moving money from banks to money markets back to banks based upon what yields offer. But to wait for this $6 trillion to come into stocks or bonds, again, I would just point out that the 19% or $6 trillion is below its median of 24.
Hmm.
And so it's probably a normal allocation that we would see right now.
Okay, that is interesting that that historical average, but still, it's easy to sit in a money market fund right now. You're not sitting there saying, "Oh man, I'm losing to." Well, you are still losing, I think, to inflation, but you're not getting beat up like you would be if rates were, uh, if you were just sitting in a bank getting basis points. So if you're a financial advisor and you know your clients are holding cash, maybe more than they need or you would recommend. I know advisors sometimes recommend 3 or 6 months worth of cash or for living expenses or maybe even longer. And if you've got clients sitting on more than that, but they're just sitting there enjoying the yields from CDs or money markets or some of these online banks, it, at what point does it start to make sense? And I know I'm asking you to forecast a little bit here, Fran, but at what point does it start to make sense to put that money back into the markets, whether they're bond markets, either bonds or stocks?
Yeah, I think you opened it up really well, Jeff. Is we believe that money markets and cash should really represent your lifestyle or your living accommodations, meaning that you should have money markets or cash equal to about 12 months of your liabilities in case something were to happen, you would lose your job or something like that would happen. Um, but then if you find yourself having more than that, deploying that according to your asset allocation. So if the client is 60/40 or 70/30 stock bonds, trying to find a way to get that cash that's beyond the 12 months of living expenses invested according to your asset allocation would make a lot of sense. A lot of clients have a hard time doing that all at once, so they could easily think about dollar cost averaging into the market if they have too much cash. Whether you do it once a month or once a quarter, that's another good way to get clients off the sidelines if they find themselves with too much cash in the portfolio.
Want more analysis and expert opinion on the world of ETFs? Make sure to tune in to Exchange Traded Fridays, available wherever you get your podcasts.
I know you said you kind of set it based on your investment strategy, but what could drive some of this activity? Would it be lower rates, lower yields on that cash? Because clearly it's not being driven off the sidelines by the strength of the equity markets, right? Not right now anyway.
Well, again, that 6 trillion didn't just appear in the last 10 days. That 6 trillion's
Hmm.
been there, and the stock market is up 15%. So, when I look at the 1 year return, the stock market is up, pretty big. So, obviously, there was an opportunity cost to sitting in cash or too
Hmm.
much cash. You really left a lot. It's back to my earlier comment of creating bear markets in opportunity costs. The stock market has had a tremendous year to date, 1 year, 3 year, 5 year return. And so if you were sitting in cash with too much cash, I would say, you gave yourself a pretty large opportunity cost that could have been invested in your portfolio of 60/40, 70/30, or whatever your prudent allocation was based on your goals and objectives.
Okay. I already know how you feel about timing, but we do have some events coming up. There's a presidential election coming up, which is unprecedented by almost any measure. We've already talked about Fed policy, but you say that's factored in, which makes a lot of sense. Is there any is do you think there's any fear of missing out here with that people might start to think about as we get closer, or not even missing out, but people want to sit out, that some of the events coming up might lead people to say, I've got more cash than I need right now. I'm beyond what my financial advisor says I should have, but I see these things ahead. Now, I kind of think I know what you're going to tell me that, invest for the long haul and so forth. But, it does seem like these are big events, or at least one big event, the presidential election.
Yeah, there's been presidential elections since the stock market, right? And not, again, a lot of people thought, at the last time when President Trump was running for the first time, and when he won, they thought it was going to
Hmm.
be bad for the stock market, and it was for a couple of days, and then it ended up up 30% in his first 6 months of office. Um, so I think first off, most people may get the outcome right or wrong. Uh, Predicting is hard. So first you have to predict the outcome, then you have to predict what the market's going to do to all of that. And then third, you have to say, what is already being priced in to the outcome and what could happen to the markets based on that outcome. So you got to get a lot of things right
Right.
against hundreds of thousands of CFAs and high frequency traders and hedge funds that have already placed all these bets. It's pretty evident,
Hmm.
day by day, the futures market on what could or could potentially not happen. So I think sitting out or having too much cash based upon some event in the future is probably not the best strategy for anyone, or especially an advisor who's advising clients.
Okay, I know you've done some research on dollar cost averaging versus lump sum investing. Let's say you're in this scenario where you have cash, you're ready to deploy it, whether it's something you've been sitting on or you maybe inherited it or come up with some kind of a windfall, sold a business or something. Is it as simple as dollar cost averaging always works best, or are there outliers or other scenarios to consider?
Yeah, we never use all because all never really holds.
Mhm.
On average, going into the market right away has paid off the vast majority of times. Dollar cost averaging is more a behavioral issue than it is a mathematical issue. Again, stocks outperform bonds, bonds outperform cash on average, but you could have put all your money to work, on October of 1987 and had a really bad event. And so what we really see is that math shows that on average, it's better to be lump sum, go in all right away because there is risk premiums to the market, meaning bonds should outperform cash, equity should outperform bonds because they're higher risk on average. But again, on average just means that on average, there are
Mhm.
days, weeks, months, and years where it would have actually backfired. So dollar cost averaging is a behavioral aspect, not a mathematical aspect. And it does help people get back to their portfolio if they find themselves with too much in cash.
Okay, I want to wrap up here with a question back to fixed income. I want to go back to the kind of investing in fixed income and talking about bond laddering strategies. There are some financial advisors that swear by these. They say they're it's a sleep at night strategy. You've got your bonds that mature. When they mature, when a ladder matures, you either buy more or you buy more stocks or you spend that money or however, there's so many. It seems like it just simplifies the fixed income side of the portfolio, especially when you're talking about, people in the income or withdrawal stages. There are ETFs out there that are specifically designed for this. It's not like, 100 years ago, like 30 years ago when you had to actually buy individual bonds and hold them to maturity. What are your thoughts on bond laddering strategies?
Yeah, I'll just put a plug in. Vanguard's Investment Advisory Research Center, of which I run, has published papers throughout its 20 years on this topic of bonds versus bond funds, laddering versus not. And it's another behavioral aspect of the market. Clients do, and advisors believe getting their money back at par has some behavioral benefit. Basically, it's a stale price, meaning that if the interest rates were to go up and you had bond A, it doesn't mark to market, and a lot of clients won't mark to market, meaning that bond is worth less.
Hmm.
And if you were to sell that bond below its market value and reinvest it at a higher interest rate, the total return would end up being the same. And so it's actually it's another behavioral quirk that people believe in that actually has real costs to it. While you are sitting there, it really limits the ability to stay fully invested and stay fully
Hmm.
invested across the yield curve. And so while it is a behavioral aspect of investors don't like a floating NAV or a floating price, they'd rather have stale price and stale mark to market and get their par back. It is one that actually has cost to it. It's a lot to go into verbally here, but I'd just encourage if anyone wants to look, Vanguard Investment Advisory Research, bonds versus bond funds. We have a full paper on the topic, and we've been covering this topic for 20 years.
And where people is at Vanguard.com, or is there a few more clicks to get to that actual uh, investment advisor research center?
Yeah, so we actually have a Vanguard for financial advisors. So it's
Hmm.
called Financial Advisory Services. FAS is how you would get there. And in there, you would look at Investment Advisory Research Center. That's the team I run. And we have a paper that is published that can be used. It's called Bonds versus Bond Funds.
All right. On that note, we're going to leave it. We're going to let everybody go over to the Vanguard website and do a little more research on these topics. I want to thank you, Fran, for being here. Really helpful, really insightful, and let's stay in touch, and we'll follow up in a few months and see where we are then. Okay.
Yeah, great questions, Jeff. Thanks for the time.
All right, Fran, thanks for that. Good insights, good conversation. Want to remind our audience to go to ETF.com, check out the Advisor Center. There's all kinds of stuff there tailored specifically for you and your clients, essentially, ways to help you better manage portfolios for your clients. Also, check out the show notes for this episode where you will find links to some of the research that we discussed with Fran. Thank you very much. Schwab Asset Management is proud to sponsor the Advisor Upside podcast with ETF.com. With bond market conditions looking upbeat for 2024, Schwab stands ready with a suite of low-cost fixed income ETFs. Learn more at schwabassetmanagement.com/welcome-ETFs.